Welcome, everybody. This is Let's Talk About It, our weekly discussion on a different topic economically that affects the Black community. Um, I am your host, Michael Evans. And before we get started, there's a disclaimer that I want to run through, and it should be showing on the screen that the information presented in this discussion is strictly for educational purposes only. We strongly encourage you to consult with licensed financial advisors, attorneys, and tax professionals. And though I do have over 30 years of experience creating and managing complex operational and financial systems, I am not licensed or registered with any regulatory authority. And the next thing that I'm going to do is we're going to do a quick 2 minute um, intro, video intro. Let me just turn the sound on. Um, and here we go.
All right, let's get into it. We're going to break down the anatomy of a turnkey rental deal. A lot of people think of these as the perfect hands-off investment. Looks ideal, right? The promise is simple: a renovated property, a tenant paying rent, and passive income from day one. Okay, so that's the promise. But what's the reality? Is it really that simple? Let's dig in. Here's the key: a successful deal isn't a promise, it's a process, a really disciplined one. It's all about a structured approach where the quality of the deal has to trump convenience every time. So, a true turnkey deal has three core components already locked in for you before you buy. This is so important. Your returns don't just happen, they're actually engineered before you ever close. And that means you've got to get in there and underwrite four key variables. Let's break them down. First up, acquisition price. Is the price based on its true market value, not just inflated numbers? Second, what's the rehab scope? You have to verify the quality of the work and materials used. Third, those rent assumptions. Are the projections realistic? Are they backed up by solid market data? And finally, expense underwriting. You got to make sure all the operating costs are planned for realistically. So here's a great question. Who actually gets paid in one of these deals? It's pretty revealing. Well, a whole chain of people take a cut before the property even gets to you, the investor. And this brings us to a super critical inspection point: cosmetic fixes versus durable quality renovations. See, new paint looks great in photos, but the HVAC and roof, that's what really determines profitability. Knowing all this helps you spot the red flags. So, what are the most common pitfalls here? Be careful, because these 5 pitfalls can turn a promising investment into a huge financial headache fast. And this is exactly why you have to invest with discipline, not emotion. It's all about the data. Really, it all boils down to one thing: discipline over hype. You got to focus on the numbers. So what's the mindset? Challenge everything, build systems, and demand total transparency, no exceptions. Which really leaves you with one final, absolutely crucial question to ask yourself on every single deal. Are you really analyzing the anatomy of the deal, or are you just buying the story?
All right. So let's jump into it. Um, Also, just to give you a little bit of my background, let me see. Our video isn't showing. Oh, there it is. So just to give you a little bit of my background, I've been a real estate investor or involved in real estate since 1997, when I was paid $15,000 to buy my first house. I've personally owned 3 properties, and I've never put a penny of my own money into any real estate deal. I currently run the BNIC network, which has a real estate investment management company in which we manage real estate deals on behalf of investors. But we only do it for properties in the city of Detroit. And what we do is we create turnkey low income Section 8 rental properties for investors. And my focus is on risk management. And so, as I go through this presentation about the anatomy of a turnkey rental property deal, at the end, I'm going to go over some actual numbers of the property that we have in Detroit. So, turnkey. So turnkey is a process and not a promise, right? It's about having a disciplined approach to acquiring cash flowing assets. So you're talking about renovated properties that have been fully rehabbed and are rent ready. They are either already have a tenant in place or one is in progress. Also comes with professional property management. And the most important thing is that the deal quality trumps convenience. Now, the deal is made before closing. So when we're talking about um, turnkey rental properties, it all starts with the acquisition price, right? Where you got to get the property as a distressed property below market value um, and not inflated um, compared to the comparables. Um, you also want to know, look at the rehab scope. You want to look at what is the level of rehab? Is it just cosmetic? Um, or is it functional where you're going to be rehabbing the systems of the property, such as the HVAC or the water system or the electrical system or the roofing? And then you want to look at the rent assumptions. A lot of so-called turnkey rental property offerings will have inflated rental assumptions rather than realistic conservative rents. And then it's about expense underwriting, right? The devil is in the details, and you want to make sure that all of the costs are accounted for when it comes to the operating costs. So who actually makes money as part of this type of real estate deal? So you typically have a wholesaler, and the wholesaler is the one that typically has the distressed property under contract, and they're the ones that are responsible for assigning the contract for an assignment fee. You have the rehabber that rehabs the property uh, and also builds in their profit margin. You have the turnkey provider that packages and markets the finished product. You have the property manager that takes a slice of the ongoing rental income. And then finally, there's the investor that earns the return when the property has a positive cash flow. So when we're talking about rehabs, there are cosmetic rehabs versus, again, the rehab of systems. So cosmetic rehabs look good in photos, um, but they can mask underlining mechanical or structural problems with the property. And if you're not aware of um, these issues with the systems of the house, you can wind up buying a property that is going to be full of problems going forward. So this is where a proper inspection becomes critical, right? You want to do a full inspection, paying close attention to the HVAC system, plumbing, electrical, the roof. Is everything up to code? If you're going to rent it out to Section 8, which we focus on, you want to make sure that it's able to pass the Section 8 inspection if it hasn't already. Um, and so that this will minimize your long-term maintenance risks and costs. So the revenue, it's got to be underwritten, cannot be assumed. You want to look at market rent versus pro forma. So in a pro forma, a person can put any type of number. And in fact, most are going to put in the highest numbers in order to make the deal look the best. But you want to compare rents against verified comparable rents in the immediate area. Then you want to look at the tenant type. Section 8 vouchers offer stability. In Detroit, with our partner, which is Great Lakes Property Management, they've been managing Section 8 tenants now for around 20 years, and they've done over 300 turnkey properties and have more than 300 properties under management. Their average Section 8 tenant stays for about 4 years. Um, and so you want to look at stability versus with a cash paying tenant. You may be able to get slightly higher rents, but odds are you're going to have higher turnover. And then you may run into some non-performance of paying rents. So that leads to the vacancy rate. You want to build in realistic vacancy assumptions, again, based on local turnover patterns. And one of the most important things is lease quality. This has to do with the tenant screening. And this is where it's imperative that you're dealing with a property management company that has the experience in doing very good tenant screening in order to get the right tenant that's not going to be a problem tenant, and that will hopefully be a long-term tenant. It is worth the time to screen out the correct tenant versus just accepting the first tenant that meets minimum requirements. You really want to put in the time to find that right tenant. Um, so the cash flow lives in the details. So cash flow is generally your gross rents minus your operating expenses, which equals your net operating income. Now, your operating expenses. Um, this is where you're going to deal with your property management fees, which is typically 8 to 10%. You want to set aside a maintenance reserve according to the rehab that's done in the inspection. It could be anywhere from $50 to $150 per month that's put into a maintenance reserve. You also want to put money into a vacancy reserve. Um, Whenever there's a vacancy, you're typically going to have to turn over the property. So that means you're going to have to make some minor repairs as long as the tenant leaves the property in decent shape. You may have to replace flooring. You may have to do some painting. May have to make some minor repairs. Um, and it may be a month or two before you're able to get a new tenant in there. So you want to have a vacancy reserve so that you can still cover your operating costs. Property taxes and insurance. And this is going to vary widely based on the market that you're in. And then capital expenditure planning. This has to do with the replacement of the systems, the replacement of a roof, of an HVAC. Um, that all has to do with the rehab that you had done, as well as the inspection. So the inspection of the property is going to inform the level of rehab, and then the rehab is going to dictate how much money you need to set aside going forward to replace the systems of the house. Um, and then there's the LLC annual business operating expenses. We recommend that you always hold the property in the name of an LLC or a trust. If you hold it in an LLC, um, you've got some operating costs, registered agent service, there's mail forwarding service, there's an annual report that the LLC usually has to file with the state, as well as if it's um, a multi-member LLC, you'll also have to file an annual tax return also. So um, it's attention to these details that will help you evaluate whether or not a turnkey rental property is a good deal for you or not. Um, Systems beat proximity. So I've heard people say, I want to be close enough to where I can visit it if I need to. And I ask the people, when you buy stock in a company, are you visiting the company? Or are you more concerned about the quarterly earnings? Are you more concerned about the performance of the stock and the company? And so it's about operators executing consistently. So this is where you want to make sure that you got a strong turnkey operator that has systems in place, because um, having quality systems matters a lot more than where you are located, the market that you're in. So I'm based in Southern California. I would never recommend a client to invest in California property for cash flow, because it's almost impossible to get positive cash flow in California versus in Detroit, it is relatively easy to get cash flow. And dollar for dollar, you will get more cash flow in Detroit than you will in California. And it's like that in many markets in the Midwest. Repeatable processes. Again, this is where you're dealing with an operator that has systems in place, systems for identifying properties, systems for managing risk, systems for executing the rehab, systems for screening the tenant, systems for managing the tenant. Um, and so if you're diligent and you're in the dealing with markets in the Midwest, it's not very difficult to get double-digit annual returns on buy and hold turnkey rental properties. So let's talk about where turnkey deals go wrong. So the first is inflated rents. This is where the pro forma is using inflated rents in order to make the deal look much better than what it actually is. Thin rehabs. This is where the estimate of the rehab doesn't take into account the actual time that it's going to take for the rehab or the actual cost of what needs to be rehab. You also got to take into account the unforeseen. And so again, This is why it's important to have a full certified inspection that identifies the um, the issues associated with the house, and then you base the rehab based on that inspection report. And then you always have a contingency. Underestimated operating expenses, um, vacancy and maintenance are the two that if you don't put reserves aside, um, odds are it's going to come back to bite you. Um, just taking 100% of the net operating income after management fees, property taxes, and insurance, and not setting aside any into a reserve, um, you will it'll come back to bite you. And then weak management, poor tenant screening is probably one of the biggest mistakes that is made when it comes to renting properties. So you want to make sure that you've got a strong property management company that has the years of experience in tenant screening and is responsive to maintenance requests. And then number five, no reserves. I kind of went over that. So turnkey done right is all about structure. This is where it's discipline over hype, underwrite everything, challenge every assumption that's presented to you. Um, Build systems. Make sure that the turnkey operator that you're dealing with has systems built. Um, and clarity builds wealth. Transparency. You want to go over every detail. Honest expense modeling, and realistic expectations. Um, and again, this is what we do, but we only do it for properties in the city of Detroit because we believe that Detroit is the best rental income producing market for single family properties. And there's a lot of opportunities in Detroit. So, with that, I want to take a quick break before we go into the details of an actual deal, and I want to see are there any questions so far. I know I ran over things kind of quickly. Okay. Not hearing any questions. Uh, let's jump back into um, going over an actual deal. So the property that we're going to talk about is 17917 McKay Street in Detroit. A client of ours purchased this property back in March of 2023. And we were responsible for walking this investor through everything. Um, and it's a two-bedroom, one bath property, 744 square feet. It has a basement. Lot size is about 4,000 square feet. It was originally built in 1954, but the seller that our investor bought the property from had bought this property from the Detroit Land Bank Authority in 2021. And when you buy a house from the Detroit Land Bank Authority, that means that the former owner defaulted on the property taxes. And so at one point, the Detroit Land Bank Authority had 100,000 vacant lots or boarded up homes. And you can go onto their website and you can bid on these houses starting at $1,000. And so They are typically the worst of the worst. They need a lot of work. So the seller had bought this property in 2021, totally rehabbed it, and had placed a tenant in it in 2021. And the way it was advertised, and it was, and this is after we had rehabbed it, but it was advertised by a wholesaler for $45,000 with a tenant. Actually, it was fully rehabbed in 2020. And there was a tenant that was paying $800 a month in cash on a month-to-month basis. Um, and it was being sold as a turnkey rental property. So this is where semantics come into play. So the wholesaler was marketing this as a turnkey because the property had been rehabbed, it had a paying tenant in it, but it did not have professional property management associated with it. And so, um, to the untrained eye, this might look like a slam dunk. You pay $45,000, you get a tenant that's paying $800 a month, and you can, manage this from out of state. The tenant had been there for a few years, like 2.5 years. But this is where our due diligence really came into play because we peel back the layers of the onion. And as we started peeling back the layers of the onion, we got a chance to talk with the tenant. And um, we told the tenant we're looking at buying the property. And if we bought the property, would the tenant be willing to enter into a 1 year lease? And the tenant told us, oh, no, I'm actually looking to move here within the next couple of months. Okay. That's red flag number one. Okay. Um, then we started asking about utilities. And so I asked the tenant who pays for the gas and electric. The tenant said, well, the gas and electric are in the name of the owner, but I pay the utility bill. Okay. What about the water bill? Oh, the owner pays for the water. Hmm. Okay. So then when I talked to the seller, I said, who pays the gas and electric? He said, well, the gas and electric are in my name, but the tenant pays it. Okay, that checks. Who pays the water bill? Oh, the tenant pays the water bill. Okay, huge red flag because both of them are saying that the other pays the water bill, which means nobody's paying the water bill, yet the tenant has water. And so that was another huge flag um, because that means that the tenant is illegally using water, and we don't want to assume that risk. And so we, um, I talked with the wholesaler. The wholesaler had this under contract for $30,000 and was trying to sell it to us for 45,000 to where he would make $15,000. And he actually just wanted to sell us the contract for $15,000. It's easy and clean with him because then he doesn't care if we close or not, because now we have to deal with the contract. So once I found out more of these details, I told him we were going to walk away. And so we wind up renegotiating. We renegotiated his fee down to 7,000. So now the investor was going to pick the property up for 37,000. The tenant said that she was willing to sign a 1 year lease agreement at $900 per month, and that she was willing to put this in writing. And the seller said that he was willing to do a water escrow, which is it's an amount that's held in escrow until the water bill is settled, and that he was going to be willing to do a water escrow for $5,000. So that means of the $30,000 that he's receiving, 5,000 would be held in escrow until the water account was settled. And so I presented that to the investor, and I said, look, there's a 10% chance that this will go forward as planned, and you'll get a tenant paying $900 a month. You won't have to pay anything on the legal water use, and you only pay $37,000, and you will have found a diamond in the rough. That's a 10% chance. There is a 90% chance that upon closing, the tenant won't sign a lease. You'll have to evict her, and you'll have to do some repairs to the property. And so, um, and the investor understood the risk up front, and she understood the details, because one of the things that we did is I went through with her with this detailed breakdown of the purchase. And so this pro forma breaks down all, what the rehab cost is going to be, how much she's going to have to pay, the wholesale fee, inspection costs, title, escrow, property tax, insurance, holding costs, tenant acquisition costs, which is typically the first month's rent. And so the investor went in eyes open, and she was prepared. And I told her, you need to set aside up to $55,000 in case we have to evict this tenant, rehab the property, and place a new tenant in it. And so, unfortunately, upon closing, the um, the tenant decided that she did not want to stay. Um, we wound up evicting her, and then we wound up rehabbing the property. Um, Nothing major, because we did have an inspection report that did show that everything had been recently rehabbed back in 2020. And so it was flooring, it was paint. Um, and so, the rehab costs were a little bit under $11,000. And then we turned it over to the property management company, which did the rehab. Um, and they went through an extensive screening process. I originally wanted them to rent the property out for $1,000 a month. They said, Mike, a more realistic number is $900 a month. I said, let's try 1,000. And they did that for 2 weeks. They got about 25 applicants, but none of them met their screening criteria. I said, lower it to 950. They said, Mike, we really think that 900 is the number. I said, let's do 2 weeks at 950. This time we got 35 applicants, but none of them meet the screening criteria. But we did have one that had a Section 8 voucher, but the Section 8 voucher was for $866, but it was for a one-bedroom voucher. And so the property management company said, Mike, you really need to accept this Section 8 tenant, because they're going to get 2 bedrooms when they only have a voucher for one. They're going to really value your property. They're not going to mess it up. They're going to probably stay longer. And so that's what we did. We accepted the Section 8 voucher at $866. And even at that rent, um, it still wound up generating more than a 10% return for our client. And that tenant was placed in November of 2023. I mean, yeah, of 2023, and has been there ever since. And we haven't had any problems. And so on this next page, this shows what the buy and hold numbers look like. And this is for the current, this is for 2025. And so it shows what the annual insurance is, the business costs associated with holding the property in the LLC, the property management fee, annual property taxes. Um, and so um, the monthly operating cost comes out to $323. Um, the rent is $925 because we did get a rental increase through Section 8. We do set aside $50 to go into reserves for the vacancy rate and for maintenance. And so the net operating income before reserves is $7,200, which is a 13.6% cash on cash return. But more importantly, this is a cash flowing property in which the investor um, has never been to Detroit. Um, this was the first property, investment property that she's owned, and all she does is wait um, once a month for the rental check to come from Section 8 to the property management company on the first. They reconcile their statements and issue a statement on the 10th. And usually 1 or 2 days later, there's a direct deposit that goes into my client's LLC's business account for the rental amount minus the property management fee. And it's been going like that for clockwork, going on over 2 years. And so this is truly a turnkey rental property now. And we even have sold part of the LLC to other limited non-voting investors. So the original investor took the risk because she created the turnkey rental property. The limited investors that came in, they bought into the property after it was already an established turnkey rental property. And so while the original investor invested $53,000, she sold part of her LLC, $33,000, based on a valuation of the LLC being worth $84,000. Now, why was the LLC worth $84,000? Because of the cash flow. And so we sold part of the LLC based on what's called the cap rate. And so the cap rate is just basically what's the amount of cash flow that an asset is throwing off each year. And so we did it based on the cap rate of 8.5%. And so for an 8.5% return that's paid out on a quarterly basis from the net operating income, she sold $33,000 of her LLC, but she owns 60% of the equity. So she gets 60% of the net operating income. So from an equity perspective, she still has over $50,000 worth of equity. And so her return, even after my company's profit share, she's over 17%. And then we've got passive investors that make around 8.5%. But they never had to take on any of the risk associated with creating the turnkey rental property. And now we're in the process of trying to sell the entire LLC with a 7.5% cap rate, which means we're looking to sell the entire LLC for $100,000 to where someone can buy the entire LLC, which comes, again, already rehab with a Section 8 tenant, a Section 8 contract. The rental property management agreement is in the name of the LLC. The title is in the name of the LLC. So, from outsiders, including the Detroit Housing Commission, everything is in the name of the LLC. So, nothing changes. The only thing that changes is who owns the LLC and who receives the net operating income. And so now we are marketing the selling of the LLC for $100,000 for someone to receive net operating income of $7,500 per year, with the intent of taking the profit, distributing it to the investors, and then hoping that they'll reinvest at least $50,000 in order to create another turnkey rental property, and then we can rinse and repeat. So that's a real life explanation of how turnkey rental properties work, from creating the turnkey rental property to um, buying part of a performing turnkey rental property to ultimately marketing a well-performing turnkey rental property. And with that, that is the end of my presentation. And um, Lori, did you have any questions?
Hey, no, I don't have any questions at this time. I'm just here to learn, just to listen and see, you know, see how things are going with this. But I mean, I appreciate you allowing me to. I do.
Well, just a general question. Do you have any real estate investing experience?
No, none at well, no, I don't. I don't. I know at one time when I was looking at I was looking at um um a building which I did purchase, but I ended up selling it for the same price in which I had purchased it for, because I knew that I could not, at the time I just couldn't do anything with it. So, and so that kind of sort of shot things in the foot for me as far as trying to do any type of real estate.
Okay, all right. So you were a short-term real estate investor.
Yes, I mean I had it like for a year, and I was and it was located in a, because I was actually going to use it as a nice venue for, relaxation, as far as, just playing nice jazz, opening up like a jazz. And I
Hmm.
think too, the thing is that the location of it was because they had a church that was right beside it. So um I'm like, okay, this obviously is not going to work because they're going to deny it, you know. So location is key. But it was also in a TIF area. So whatever improvements I would have made in it, I would have been given the funds back, because you know, the TIF funds would have compensated me. But other than that, no, yeah, I just lost it after that.
Okay, all right. Well, and so, the one thing that we do is in addition to, educating people about different investment strategies is, we do manage real estate deals on behalf of investors. And so we handle all of the risk management. So we use our tools to identify the properties, and then we have partnered with people on the ground in Detroit that do our pre-offer inspections, where
Mm-hmm.
we take pictures of properties inside and out, as
Mm-hmm.
well as the neighborhood and people that know the neighborhood, and then we evaluate that with our rehab and property management partner, Great Lakes Property Management, um,
Mm-hmm.
so that we can update the assumptions that we use in our pro forma. And then our software tells us deal or no deal, because there are very specific parameters that we're
Mm-hmm.
that we're looking for. And one of the important parameters is the rent to price ratio. And so I live in Southern California,
Mm-hmm.
and I live in one of the more affordable parts parts of Southern California.
Okay.
And so an average house might cost $500,000 and may be able to rent it out for $3,000 a month.
Mm. I don't know how anybody can actually, I mean, unless you have that. I'm sorry. I'm sorry. Yeah.
No, no, believe me, it's crazy. It is crazy.
Woo. Man.
And like I said, it's one of the more affordable places in
Mm,
Southern California.
mm,
Uh, but from an investor's perspective, when
mm-hmm,
you look
mm-hmm,
at the rent to price ratio, where you take the monthly rent and divide it by the purchase price,
mm-hmm.
um, take $3,000 a month divided by $500,000, and you come up with 0.6%. So that's less than 1%. Okay.
Mm-hmm.
So let's keep that number in your head.
Okay.
0.6%.
Okay.
In Detroit, specifically in the areas of Detroit where we're talking about Metro Detroit,
Mm-hmm.
where you can um, purchase and rehab total project cost, 3 bedroom, 1 bath property for $50,000, and it'll rent for $1,000 a month.
Okay. Okay.
So $50,000, $1,000 a month. That rent to price ratio is 2%. So 2% compared to 0.6%.
Yeah.
So so the rent to price ratio is more than 3 times greater. Well, what does that mean, practically speaking?
Mm-hmm.
Well, so it means this: if you had $500,000 to invest, you could buy one property in California and get $3,000 a month in rent, or you can buy 10 properties in Detroit, rehab them, and rent them out for $1,000 a month each to get $10,000 a month in
Yeah.
rental income. So for the same $500,000, what would you rather do? Get $3,000 a month in rent, or get $10,000 a month in rent?
Yeah. I'll go with the 10,000.
Exactly, right? Um, and
Mm-hmm.
and from a risk management perspective, if you've got $500,000 and you use it to buy one property in California, and something goes wrong with that one property,
Mm-hmm.
then you're out of luck, right?
Yeah.
You don't have any rent.
Exactly. Exactly.
But if you have 10 properties in Detroit and something goes wrong with one, you still have nine other properties
Yep.
that are generating $9,000, right?
Mm-hmm.
So,
Mm-hmm.
so again, it's risk management also. So it's cash flow is risk management. Um, and so, I teach people about this.
Okay.
Um, and we've been doing it for um, 3 years now. And
Oh,
we partnered with the company that's been doing it for over 20 years. And yet, it's still hard to convince people to invest in Detroit. I think some of it is people have a hard time with out of state investing,
okay.
as though being in the same city where the real estate is is going to make a difference, unless you're a real estate professional.
Uh-huh.
Because if you're not a real estate professional, you're still going to depend upon somebody else to
Absolutely.
to manage the aspects of picking the right property, negotiating the price, dealing with the rehab, dealing with the placement of the tenant, um, and and sure, you may be able to manage the property yourself, but who wants that headache,
Exactly. Exactly. Yeah.
right?
And nah, that would be a tremendous headache for me if I had to do that.
Yeah. And so, for out of state investors investing in Detroit to earn a double digit annual return with low risk, um, so, for an investment of $50,000 to generate $7,500 a year in net operating income,
Hmm.
um, uh, is very low risk, especially when you add in the Section 8 part. Um, but everybody doesn't have $50,000. And,
Right.
and so this is why we have sold part of the LLC that owns the real estate, and we sell it in $500 increments. Um,
Okay.
Now, you're not going to earn, the 10% plus return, but you're still going to earn more than what you would if you were investing in bonds. You're gonna, get an 8.5% return. You're gonna get your share of the net operating income
Mhm.
that's paid out on a quarterly basis. Um, and when we do sell the property, you also get a share of the profit on the backside. Uh,
Okay.
and so, and we've made that accessible to anybody because it's, again, we sell it in $500 increments. So um, if you're interested in learning more about that, what I'll do is I
Yeah,
will
I
put.
am. As a matter of fact, I'm sorry, I don't mean to cut you off.
Yeah, go ahead.
What parts of Detroit? Because I mean, I've been there before. I've driven to Detroit since it's like an 8 hour drive. I went there for a small conference, a small business conference, um, and I stayed at the I was like, I guess the, let's see, let me see, was the Motor City uh hotel. I'm trying to think.
Hmm.
Was that the name of it? I think. And I loved it. I mean, it was really, I liked the hotel, I guess I should say, because I didn't get to see much of the area since I was there for a business meeting. But but yeah, so I'd like to know where specifically are we talking, the areas that you look that you taught that you are.
Sure.
Yeah.
So, and we are data driven, and so we focus on zip codes that have the highest rent to price ratios.
Uh-huh. Uh-huh.
Um, and those are typically going to be in Metro Detroit, so Detroit
Mm-hmm.
proper,
Mm-hmm.
um, and they're going to be in, quote to quote, the hood
Yeah.
area,
Oh yeah.
right?
Yeah.
But we're on a mission to not just create steady income for our investors, but our greater mission is to create affordable housing for
Yes.
for Black folks because Detroit is still, 80-90% Black.
Yeah.
Um,
Yeah.
and and it is undergoing a tremendous change that started in 2018. They've got a brand new downtown area, brand new waterfront,
Okay.
and um, most of the midtown area has been rehabbed. And then what happened is the developers skipped over um, the inner city and
Mm.
went and played in the suburbs, um, which leaves a great opportunity for redevelopment in the inner
Mm-hmm.
city. Um, and so and the it took us 2 years to find the right partner to partner with in Detroit, but we found a Black owned full service real estate company
Mm-hmm.
that's been creating these turnkey rental properties for now 20 years, and their sweet spot is the $50,000 mark.
Okay. Okay.
Yeah.
Hmm. I would like, yeah, I would like to learn more about it. Also, because from a um, an IT perspective, to maybe perhaps to see just how, that could also play into, from be another means of generating revenue. Because that, I mean, because that's my business that I do now, that I'm still, that I'm getting off the ground, I should say. Um, but yeah, to see how to actually use that, bring that in order to assist in the from the IT perspective, the infrastructure perspective.
Okay. Well, what I've done is I've put a link to my calendar. Um, so you can use that link to schedule a one-on-one Zoom meeting with me,
Okay.
and then we can talk in more details about what the investment opportunities are.
Yeah, yeah, and this is in your LinkedIn.
No, I put the link into the chat of this Zoom meeting.
Ah, okay, okay. I see it.
Yep.
Okay. Yeah, that would be ideal to be able to continue the conversation.
Oh, definitely, definitely. And Tim, how are you doing today? Tim, can you hear me? He may be doing something else. Um, so also, Lori, just to let you know,
Mhm.
um, so this is part of the CPIN, which is the Closed Private Investment Network.
Okay.
Um, it's a network of like-minded people that come together to practice cooperative group economics,
Yes.
um, where we're about um, pulling our resources and our money together in order to invest in investments that we typically wouldn't be able to invest in alone or wouldn't be qualified to
Mm-hmm.
invest in.
Mm-hmm.
And so we also have a very strong educational um, center, um, and um, where we have different financial topics because we
Okay.
want you to be a well-informed investor so that you can make better informed investment decisions. And,
Yes.
and then we have this um, conversation. Let's talk about it. We have this every other Thursday at 6 p.m. Pacific time, 9 p.m. Eastern time. And
8
so
p.m. Central.
there you go. And so I also put a link in the chat to the Closed Private Investment Network. So I encourage you to visit that. And if you feel like you want to become a member, because it is a members only platform, um, just ask that you apply, fill out the application, and then you'll get immediate access to our knowledge center. And then once we review your application, then we'll give you access to the full members only area. And there's currently no cost to become a member.
Okay. Okay. Yeah, I just opened them up and so that I would be able to get back to them once we finish the Zoom meeting. So
Okay.
yeah, absolutely, absolutely.
Uh, let me try Tim one more time. Tim, are you there? No, I think he's there in spirit. Um, so we this has been an hour, and I don't want to take up anybody else's time. Lori, you got any final questions or comments?
Um, I know you said you're originally from Detroit, right?
No, I'm
No.
born and raised in California.
Oh, okay, okay. Well then, because I was going to ask maybe that because I was thinking that maybe that was the reason why you were looking at Detroit. But have you considered area of and I know people probably going to you don't think ill, but I live close to East St. Louis. Okay, I don't live in St. Louis, East St. Louis. I'm only about maybe 15 minutes away from it. 15, 20 minutes max. Uh, but that's another area that, you you might want to look at as well when it comes to doing the turnkey or buying properties and things like that. So, but I think they're going under Cahokia Heights. I think they're bringing those little town areas, townships under one one name, which is Cahokia Heights. But again, there, and then that's another story. I'm sure because I was just seeing something a day or so ago where there's like it's just too much corruption. I'll just leave it like that.
Yeah.
I'll
So
just leave it like that. You know.
so so we've identified Detroit
Yes.
um, as our where we're going to do our template.
Yes.
But we've identified 40 additional markets in which our business model is applicable, and St. Louis is one of
St. Louis or East St. Louis? Which one?
them. Because there's a difference.
East St.
My
Louis,
father's
Illinois.
right. My father's family is from St. Louis.
Oh,
Um, and so I do know there's a difference between East St. Louis and St. Louis. Um,
yeah.
but uh, but we're talking about what's called the metropolitan statistical area of St. Louis, which I'm pretty sure includes East St. Louis. Um, but so and here's when we look at a market. First, what we do is we look at markets by zip codes,
Hmm.
and
Right.
so
Okay.
we do an analysis of every zip code in the United States. We use Zillow historical data,
Hmm.
and we look at and we calculate the rent to price ratio, and then we rank them.
Okay.
Um, and and so that's the very first thing. And Detroit, it just so happens that it happens to have three or four zip codes that are in the top 20
Okay.
of
Okay.
and and then so that's the very first criteria. Then we look at other criterias, such as the availability of distressed properties. And so this is another reason why Detroit is number one on our radar, because again, the Detroit Land Bank Authority at one time had over 100,000 vacant lots or boarded up homes. And
Wow.
now they have like around, they still have around 60,000, right?
Mm.
Um, and which you can, you can go onto their website and you can, bid for them starting at $1,000.
Oh,
Um,
really?
yes.
Huh.
Now that if you bid on a property for $1,000 and you win that bid, because there are a lot of properties that don't get bid on, so
Uh-huh.
and then they basically release those properties for $1,000. After all is said and done with closing costs and everything, it'll be about $2,500 out of pocket. Um, but you got 6 months to bring that property up to habitable
Oh,
um, specifications. Um, and so that is going to run you around $50,000.
uh, okay.
Okay. And so, um, unless you are really well versed in rehabbing Detroit Land Bank Authority properties, I wouldn't suggest doing that. Now, there are some rehabbers in Detroit. That's how they make their living. They
Mm-hmm.
they buy these properties, they put in the sweat equity,
Yep.
and they're all in around 30 to $40,000. And then they turn around and they sell those properties for 75, $80,000.
Okay.
Um, and so um, but none of them have been able to scale yet. They don't have the right systems in
Okay.
And
Okay.
so it's a very fragmented market and it's so big. And it's like, we could spend years buying up blocks
Mm-hmm.
in Detroit and rehabbing, especially bringing out of state money, right?
Mm-hmm.
So in California, I gave the example of of an affordable house in California costing $500,000. That would create 10 properties
Mm-hmm.
in Detroit,
In Detroit, yes.
right? And so that's why we've originally really focused on California investors, trying to bring California money to Detroit. Because if you're a California investor and you try to invest in California, your cap rate is going to be in the low single digits, like 2 to 4%,
Mm.
right?
Mm.
Whereas if you're an investor that creates a turnkey rental property, you're going to be in the double digits
Mm.
in Detroit. So and to buy a property in California, um, most people don't have $500,000 in cash lying around. Uh,
Hello.
and so to buy an investment property, you're usually going to need 20 to 30% down, which means you're still going to need 100 to $150,000 cash in order to get a loan.
Mm.
That loan payment eats into your cash flow, which is one
Mm.
of the reasons why it's almost impossible to have positive cash flow in California.
Mm. Mm. Mm.
Versus if you have $100,000, you can
Mm-hmm.
go and get two properties in cash in Detroit that generate $15,000 a year,
Mm-hmm.
right? So, um, and so it's just it's been difficult to get people to get over the mindset of, well, it's Detroit, right? That's been the
Right.
been the number one. It's been a mental block. I have,
It can't be any worse than what, how people had the I guess with the East St. Louis one aspect
yeah,
too, So, and you just the thing is that I can understand why it's that way, but that's neither here nor there. Um, but yeah, it's going in and creating nice areas because it doesn't have to be that it doesn't have to be run down or beat down or whatever, you know.
no, and this is an opportunity
Yeah,
for us as Black people to redevelop our neighborhoods
exactly.
before they get gentrified.
Yes, yes, because exactly before it be gentrified, but you know good and well that once they see that the improvement, they're still going to come in there and do it anyway. Let's be
Well,
real.
yeah, well, we have some long-term plans. So,
Yeah,
I mean, as you can see from my background, I am pro-Black.
hey,
Um,
I
and
got
and
you.
and so my companies are all about helping the Black community become self-sufficient, self-reliant, and self-determinant.
Mm-hmm.
Um,
Mm-hmm.
and creating, redeveloping our own neighborhoods,
I
and
know.
keeping
I
them
know.
Black owned, and keeping them affordable to where everybody wins, not
Yeah.
displacing the people who currently are there and who've grown up there for generations, and
Yes.
not pricing them out.
Exactly.
Um, there's enough meat on the bone for everybody to eat.
There is, but you got some very greedy people out there. We know
Sure.
this.
Yes. Yes.
We know this. Mm-mm-mm. So, but yeah, I would definitely feel those out. Both of them. Look at them, and at least and I'll set something up where we can fill it out so that we can continue the conversation. Because you piqued my interest. I just wish that I could have kept the building and did what I had. I even had an architect to come in and he drew up the plans for me as well. Um, and it was I know my vision of that building was really, I guess, grandiose, you know, but it would be nice to be able to do something like that, even for homes. Um, so yeah, I will definitely fill that out. You may see it tomorrow.
Yeah. All right. Great. Great. I'm looking forward to speaking with you. And Leroy, I see you came at the very tail end. Are
Yes,
you?
and I indeed apologize. I had 3 or 4 meetings this evening, and so I'm going to put this meeting down on my book for 2 weeks from now. Uh, is that's right, right?
Yep.
Okay, so I can remember it. I forgot to write it down, and I ended up putting 3 other meetings on at the same time, and apologizing for several of them that I couldn't make it. And I looked
That's
down at my calendar and I saw your email. I said, "Oh my God, let me see if I can catch them on the end." And I want y'all to know this is sounding good what y'all were talking about.
But yeah, we had a good discussion about turnkey rental properties. I went over the property that we have in Detroit, the ins and outs of it, and everything. And as always, the recording will be available,
Okay.
um, and you can just visit the Let's Talk About It webpage, and
Okay.
the recording will be up tomorrow.
Sounds good.
All right. With that, I'm going to wish everyone a good night. Stay blessed and stay safe.
Yes, thank you so much. I appreciate what you did this evening, and we'll be in touch.
All right. I look forward to it. Bye bye.
Have a blessed night.
Bye bye.